Hello there. Happy Friday. Welcome to the Open here on BNN Bloomberg. Another wild day for oil prices. Iran threatening to keep the Strait of Hormuz closed indefinitely and said to be laying mines in that crucial stretch of water. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Canada's economy shed the most jobs last month in 4 years. Data from StatsCan indicate that the labour market lost 84,000 jobs in February, and economists had been expecting the addition of 10,000 positions. Jobs were mostly lost in the goods and services producing industries, with 18,000 jobs shed in wholesale and retail trade. Meanwhile, the unemployment rate edged higher to 6.7%. The report signals continued softness in the Canadian labour market. China says it will impose anti-dumping tariffs on certain rubber products from Canada and Japan, with the levies taking effect tomorrow and remaining in place for 5 years. According to the Chinese Ministry of Commerce, the tariff rates will be just over 30% for most Japanese companies and about 14% for Canadian producers. Shares in Adobe down 8% in the pre-market. That's after the longtime CEO announced that he's going to be stepping down. The leader, who has headed up Adobe since 2007 and oversaw its shift from traditional software to a subscription model, says he will remain in the role until the company identifies a suitable successor. The news has overshadowed Adobe's Q1 results. It posted profit and revenue that beat estimates. And there is a look at U.S. futures. It looks like we are going to get a marginally higher open for stocks today. Let's see how the TSX ended yesterday. Not far off record highs, but down from its peak amid a weakness in shares around the world with a soaring oil price. Speaking of oil, let's get to WTI, the North American benchmark, now giving up a little bit of altitude, down around 3%. But there's been a wild week of swings here. It's still unclear how much oil is going to be off the world market for in the medium term and for a substantial period. And let's have a look at gold, see how it's trading. And gold holding its own today, but stuck well below that 5,200 mark. And let's see how the Canadian dollar is doing. It tends to gain when oil is strong. It's down a bit today, slipping below 73 cents US. And let's have a look at Bitcoin. And you can see Bitcoin edging higher, up around 4%. We saw a drop in oil after the U.S. said it's going to allow the sale of some sanctioned Russian crude to avert an energy crisis. Right now, barely any oil is going through the Strait of Hormuz in the Persian Gulf. Let's find out what this means for markets. We're joined by Greg Halter, Director of Research at Carnegie Investment Counsel. Greg, thanks very much for joining us. I know it's a moving target, but what do you think? Are you tempted to adjust your portfolio in light of these wild swings in oil?
We really haven't done lots of overall adjustments to the portfolio. I would call it more fine-tuning along the ways here. As you point out, lots of volatility, especially in the oil markets. And generally when that happens, you can have some dislocations in prices. I still think the AI trade or AI situation and its impact on software has had more of an impact so far than what we've seen in the energy markets, at least related to some of the stocks and the derivatives around those stocks.
Let's put up a one-year chart for XOM as a benchmark. Bloomberg argues that we haven't seen as big a rally as might be expected in these energy stocks. I mean, they are up.
Yeah, they're definitely up. One of the names that we look at more closely is Chevron, which is very akin to Exxon. They kind of, the prices maybe had a foreshadowing of what was going to be happening because they started moving up several months ago before we saw any kind of move from WTI, which was 55 a couple months ago only. So you're right. You've seen WTI go from 55 to 110, 120. That's a double. Now we're at about 90 or so. The stocks have not doubled. So yeah, generally the commodities move a lot faster up and down than the stock prices or prices of goods and or services.
What is your take on the Mag 7 stocks? You did comment on them. You say that's a bigger story overall. Do you think investors are going to start going back into these huge names that are spending so heavily on hardware, things people like Meta and Amazon?
They're definitely spending a lot, and that has caused some concern because their free cash flow is not as strong as it had been. But you look at the underlying fundamentals, and we just had NVIDIA and Broadcom in the last week or so. The underlying businesses for those types of companies are incredibly strong. We were just marveling at NVIDIA's free cash flow has gone from $4 billion to a projected $200 billion in 5 years. I mean, I don't think you've seen anything like that on the planet in the history of companies. It's just amazing. And you know, unless the world's economy falls off a cliff and, you know, you never know what's going on with this war, we expect these big companies to continue to do very well. Will they grow at the same rapid pace they have? Probably not, but they don't need to, given where they're trading now. And they've been kind of flat overall for the last year or so.
Is there a risk, though, that there'll be so much available capacity of computing for AI that it won't be justified by the extra profits companies earn from AI services? I know the scope is enormous, but we could get price competition, for example.
No question there. You never know. I think that question is the answer to that question is unknowable, but I think it's a build it and they will come. I just look back at Amazon's AWS, their cloud business. I think they've lowered price for 60, 70, 80 times since they've been around, and they continue to grow at a monstrous clip. So there is so much appetite out there that, yeah, there's all those concerns, but somehow related to compute and what people want to do, it seems to get filled up no matter what happens. At least that's been the history for the last 20 years or so.
You are seeing some attractive names, you say, in insurance, Progressive, Chubb, Kinsale Capital, among others. Tell us what draws you to those stocks.
I think it's the valuation. You know, those companies have all seen very strong pricing for probably the past 5 years. And maybe they've been over-earning, and I think even Progressive might even hint or even say that. They've had very strong results. You know, pricing in the insurance business, like most industries, can ebb and flow. Right now we're on I wouldn't say a big downfall, but it's just not as strong as it had been. And now you've got these stocks trading at 12 times earnings, half of the market multiple for very good companies. And we don't think insurance is going out of style anytime soon.
And it's interesting, Chubb, apparently the White House, reportedly, the White House wanted Chubb to coordinate an effort to provide insurance for shippers through the Strait of Hormuz. But so far that seems to have stumbled because the ship owners are worried about the crews being killed.
Yes, I saw that story as well. Chubb is one of the three that we mentioned here that has done the best in the stock market versus Progressive and Kinsale, which have been flat to down over the last year, and Chubb is hitting all-time highs. Chubb is a much bigger global business. They can take on much bigger risks. Progressive is an auto insurer primarily, and Kinsale is excess and surplus more to smaller accounts. So there are three insurance companies, but they're all kind of doing different things, and the stock prices are reacting accordingly.
And finally, Stryker, the medical equipment company, they make implants and stuff. They were hit by a cyber attack. You think that the recent weakness in the stock could be an opportunity?
We do think so, and the shares have been kind of flattish for the last year or so, but Stryker, 129 billion market cap, 22 times earnings, about a market multiple. But they have just been a stellar company for 40 years, just well managed. They do acquisitions, tuck-ins here and there, and just integrate them effectively. They're using technology to their advantage. Their Mako robotic surgery is gaining share. We just think this company is doing well for folks like myself who have a hip implant that are wanting to be active longer in their lives, and they're replacing hips and shoulders and knees and so forth.
Thank you very much. I really appreciate it, Greg.
Thank you for having me, Andrew.
Greg Halter, Director of Research at Carnegie Investment Council. We have lots more, including Prime Minister Mark Carney has announced billions of dollars in defence upgrades in Canada's far north. We'll have more ahead. Prime Minister Mark Carney has announced billions of dollars for defence upgrades in Canada's far north, boosting the country's military presence after the White House complained about vulnerabilities in the region. Canada now saying we're going to be able to just protect that region on our own. We won't need allies. Let's get more from Bloomberg's Derek DeCloet, Executive Editor for Canada at Bloomberg News. Derek, give us the outlines of the spending, please.
Yeah, I mean, this centers around military bases and then these operational support centers that are sort of meant to help people in the north and meant to help supply those bases. Now, it should be emphasized, the dollar figures are big, but over a very long period of time, you know, probably 10 plus years. But the core of it really here is kind of a message that we've heard you, NATO allies and President Trump about securing the North, about securing the Arctic, being able to properly surveil it, being able to properly respond if there are, for example, natural disasters or anything up there, if they're, being able to surveil ships. And so, we're going to spend the money to do it. A lot of this actually, although it's in the press release that we'll be able to monitor the Arctic without our allies. Of course, a lot of this is really meant to improve NORAD, which is the agreement we have with our ally in the United States.
And some of this, I mean, the government is talking about more than $30 billion in spending. As you say, it'll be over a substantial period. And some of it is roads and infrastructure. So it's not just pure defense. That's right. I mean, there's ammunition depots, there's fuel depots, there's bases. And of course, there's money for airports. And in addition to that, the Prime Minister also announced yesterday that there's going to be some major projects that really are not about defense, but are about economic development in the north and transportation. They're proposing an 800-kilometer road in the Northwest Territories between Yellowknife and Inuvik. I mean, these, again, are long-term, somewhat expensive projects, but they sort of need to be done if Canada is going to claim sovereignty over the Arctic and not make itself vulnerable to the accusation that it's sort of leaving the Arctic kind of untended. There's going to have to be people up there. There's going to have to be projects up there. People are going to have to move around. And so all of this is, really kind of a precursor to Carney's trip to Norway. He's in Norway right now to overlook NATO exercises. And a little bit of it is kind of stems from the whole Greenland controversy, fiasco, whatever you want to call it, of a couple of months ago, where President Trump was making very loud noises about the U.S. wanting to own Greenland. Arctic sovereignty is a really big topic right now, and the government has to respond. And Nunavut MP is crossing the floor from the Tories to join the Liberals. Does that fit in anywhere to this massive spending?
Well, I think in the sense that if you're representing the North and you are thinking about crossing from an opposition party to the government, you want to feel assured that that the North is going to be taken care of and prioritized in the spending of this government. So I suspect there is a link between the timing of that floor crossing, which was earlier this week and kind of surprised almost everybody. It was done very quietly, and this announcement. And certainly, certainly it is a good signal for the North. Now the question is, can the government execute on what timeline? Can they get soldiers to live up there and recruit for the Canadian Armed Forces, which has been a problem in recent years.
Thank you very much. That's Bloomberg's Derek DeCloet. Up next, the Canadian economy shed jobs in February, the biggest loss in 4 years. Canada lost the most jobs in more than 4 years last month, driven by declines in full-time employment and the private sector. We're joined now by Travis O'Rourke, president at Hayes. Hayes, of course, a global recruitment firm. Great to see you.
Cheers, Andrew. Thank you.
You say it was something of a bloodbath last month.
Bloodbath's the right word. I mean, I saw the U.S. data last week, and I thought, geez, I'm glad that's not going to be us. I think economists' general sentiment was we were going to add 10. I thought we'd add actually more than 10,000. So to see us shed 85, I mean, it's a moment in time, but there's very, very little good news you can pull from this one, Andrew.
Is it possible to speculate on what caused this one terrible month?
Like you've got the services sector's down, manufacturing's down, wholesale's down, construction's down. To actually find positive, this is a general softening across the whole country. Now, like I say, it is a moment in time. From someone who lives and breathes and buys groceries on employment data, I'm not going to sweat this one. This is bad, but anecdotally at Hayes, this is not what we're seeing. And I think the spring and summer, we're going to get better data.
That's interesting. So it won't continue at this dismal rate, you don't think?
Listen, what we're seeing on the ground and what economists are predicting was not this number. I think there's so many good things happening in the Canadian economy. A lot of the infrastructure investments that Carney's made. Yesterday was a great one. Kuzma clarity coming July 1st. That's what everyone's really waiting for. But I think there's brighter signs ahead.
You say that we're in the employment market. Normally, it's shaped like a pyramid. There's a few jobs at the top. There's lots of entry-level jobs. But it's more like a diamond now. The entry-level jobs are few and far between.
That's right. I'd say, like you see the youth employment data, we're not as bad as we were in September. But yeah, we're in what I would call like a low hire, low fire market. So you're not seeing those big layoffs going anywhere. But that diamond shape, where to get in that entry-level role right now, is very difficult. So people are still moving up nicely. But whether it's companies, it's easy to cut costs by saying we're not hiring new grads. It's easy to cut costs by getting some of those repeatable low-level jobs replaced by AI. And so the trouble we're going to see is 2, 3, 4 years from now, when those entry-level employees don't exist, who's going to do the middle-level roles? But yeah, the pyramid is becoming a diamond.
And I guess some of the middle management jobs will start going with AI as well.
Certainly the white-collar ones, yeah. I think it becomes a lot easier to make decisions. Data is a little bit more readily available. You need fewer people to make those calls. AI is changing everything.
Yeah, there was that Citrini research a couple of weeks ago now saying that a lot of people make their living by dealing with tedious stuff like tax filings or bureaucracy. But if AI allows the customer to do that, those jobs may go.
Yeah, if AI allows the customer, or if AI makes decisions faster. I mean, we look at some of the holdups that we've got in construction right now, or the amount of time it takes to do permitting. You should be able to send a permit into a system, 10 seconds later, AI approves your build. Instead, you're waiting 6, 8 months going through red tape for someone to actually get to your file. So there's a lot of ways that AI is actually going to increase employment, make things move a lot faster. But right now, the bureaucracy is certainly in my sight line.
The bureaucrats will resist that, though. They'll come up with ideas why they're essential.
Yes, of course. But yeah, construction for me, Andrew, that's like a huge potential for us. Your previous guest is talking about the Mackenzie Highway up to the north. To spend $35 billion on defense, it's only good if you can get there. And I think Carney's made some great announcements on the Ring of Fire for the mining. There's a global demand for rare earths and critical minerals needed for data centers, but you have to get there. So the railways, the roads, all the infrastructure required to make that happen, our construction sector is ready to go.
But there's still this perennial shortage of skilled workers.
Perennial shortage of skilled workers, yeah. I think skilled trades specifically is going to be a major challenge. We've got about 700,000 skilled trades workers set to retire by 2028, and we're only graduating 75,000 per year. To me, the answer is women. Women are so underrepresented within skilled trades, and I think they're about 8% of total trades. When you get into fields like welding, it goes down to about 4%. So we cannot address the gap in skilled trades without engaging females into that workforce.
Yeah, that's a big waste, all right. Yeah. I guess workplace culture will have to change in some cases, just so women feel more comfortable.
Yeah, I think workplace culture has to change. I mean, honestly, some of it is just structural within the buildings or on the sites. Like even things as simple as bathrooms.
Yeah.
But when you look at how to get a job on a construction site, a lot of it comes down to referrals. And Jimmy knows Tommy.
Right.
Well, Jimmy also knows Jenny. And I think it's a requirement for employees at any construction site in any trade to start promoting women, to start talking about them, to get into schools. Jack of all trades need to be Jill of all trades. And the answer is right here. And with International Women's Day that happened this week, I want to see more people in the private and the public sector starting to elevate these women into the jobs that the economy needs.
I remember a mining guy years ago, he's running a huge open pit mine with these massive trucks. He said his favorite drivers for those trucks were women school bus drivers.
Right.
Because they were very safety conscious,
Sure.
but they also didn't overwork the equipment.
Great.
Yeah, and that just preserved the life of the tires and stuff.
Oh, that's great.
He said they do the best job.
That's great. Well, there you go. Mining, oil and gas, construction. There's so much potential for the youth labor force, the labor force in general. I think our Prime Minister has done a great job announcing projects, and I think the transition between announcements and blueprints to shovels, whatever we can do right now to speed up that gap, we've got a lot of workers who are dying to get on the ground.
Travis, thanks very much indeed.
Pleasure.
Travis O'Rourke, President at Hayes. We've got those opening bells up next. There are the opening bells at the NASDAQ. It's Kraken acquisition, and that is a vehicle backed by Kraken, the big cryptocurrency exchange, celebrating its IPO at the NYSE. It's ServiceNow, the software company, and at the TSX, it's Rio 2, which is pushing ahead with a copper project in Chile. It's time for the first 15. And let's have a look at those North American markets. You can see investors apparently encouraged by the White House scramble to increase oil supplies on the market. And we are seeing some strength in stocks right now, but it has been a rocky few weeks. The Americans launched and Israelis launched their attack on Iran on December 28th. And the market is down. The S&P is down something like 200 points since then. So it could be worse, but there has been a decline. A couple of stocks of interest here. Let's check out how Wheaton Precious Metals is trading. Gold is actually down this week. Now, Wheaton announced its numbers, breaking records with these high gold prices. The dividend is going up, profit soared. But interestingly, gold is down more than $100 since the attacks. It closed at 5247 on February 27th. And right now, as we can, there's what, let's have a look. Well, the gold price anyway is 5117. Sorry, control room. I'm managing to confuse everyone there. So gold is down over the past 2 weeks since the war began. Let's check out MDA. I think we just right now have the TSX listing, but that stock has, there's the TSX, but that stock has now started trading on the New York Stock Exchange. And of course, that'll give the company more direct access to a huge group pool of investors. And they raised $300 million, and they are going to pursue mergers and pay debt. Okay, we've got lots on the boil right now. Nutrien, of course, climbing again because of the cutoff of fertilizers to the global market with the Gulf of the Strait of Hormuz shut down. Let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Adobe down. Jeff, thanks for joining us. The CEO is leaving.
The CEO is leaving, and that's the thing that's weighing on the stock so far this morning. This is the worst performer in the S&P 500. It had been down as much as 9.2% in the pre-market session. On what were otherwise good results, the company posted earnings per share and revenue that were ahead of expectations. But Wall Street really focused on the change of CEO, and in fact, Barclays downgraded the stock, citing the change this morning. So we are seeing a pretty decent sell-off. It's also worth putting this in context too. Adobe is a stock that it was already down 20% on the year heading into this day. So certainly extending those losses on the year. Adobe, as well as other companies in that space, have been kind of hit by the AI jitters, as people are concerned that AI is going to come and potentially disrupt other software and other businesses across the spectrum. So Adobe already weak coming into this. Now they're changing the CEO, and the stock, as I mentioned, is among the worst. It was the worst performing stock in the pre-market session in the S&P 500. Looks like it might be as we get into the regular trading session here as well.
And the cosmetics company Ulta providing a cautious outlook for the full year.
That's right. This outlook was below what Wall Street had expected, and as a result, this is the second worst performing stock in the S&P 500, also selling off fairly sharply. The company put out comparable sales growth for the year. It sees comparable sales growth about 2.5 to 3.5%. Wall Street wanted an average that was about 3.5. So the high end of the company's growth outlook is where Wall Street hoped the mid-range would be. And the stock is getting pummeled as a result. Looks like it's actually doing worse right now than Adobe. Morgan Stanley cut the price target on the stock as a result of this tepid outlook. Says that the company needs comparable sales growth to reaccelerate for the stock to recover.
Thank you very much indeed. That's Bloomberg's Jeff Morgan. We have lots more coming up. We are going to focus on the fallout from the closing of the Strait of Hormuz, and we'll also look at those earnings from Wheaton Precious Metals. And that's ahead. The Middle East conflict has been weighing on stocks, even though the broad indices are up today. And of course, the Strait of Hormuz shutdown, pushing oil in North America not far from $100 US. Let's get more on this fallout from Brooke Thackeray, research analyst at Global X Investments Canada. Thanks very much indeed for joining us. Brooke, Javier Blas, the Bloomberg commodities commentator, says today that the longer this thing goes on, almost despite whatever the White House tries to do to get oil flowing, it's going to relentlessly add to the price of crude. Do you think that sounds right?
Absolutely. I think there was an expectation at the beginning that the war was going to be short, and it wasn't even really factored in about closing the Strait of Hormuz. And there's a lot of optimism that it didn't, it was all going to work out. And I think what's happening now is that investors are realizing that this is going to take a lot longer, and it's going to continue to push oil prices higher. I mean, it's not just oil prices; it's a lot of other materials flowing down that strait.
How do you suggest investors play it right now? I presume own a weighting in oil stocks?
Well, I don't think you should react to having a knee-jerk reaction to any announcement that's coming out and say, "Oh, I got to do this because of this." I think you should have the allocation of portfolio that makes sense. I know that's very generic to say that, but I still think that the energy sector can do well at this point. So the oil stocks, which is the way that most investors play it, haven't really gone up as much as oil, and you'd expect that as well, of course. But we have seen oil stocks perform quite well, actually, coming in earlier before the war. And it was rising, the stocks were rising with commodities in general. So even if oil comes down, I think that the oil, without it coming down significantly, I think that oil stocks can still do well. So I wouldn't react to the oil price with the daily announcements that's happening, whether it's the sanctions being removed for Russia, because that won't last long. I mean, if this goes on for weeks, it doesn't matter. The oil curtailment is going to be too big, and that's really going to push oil higher. So these short-term announcements are just buying time. But I wouldn't be making an allocation to say, "Oh, this is I need to increase dramatically on the oil stocks here," or less. I still think that oil stocks can still do well here, despite what happens.
We got numbers from Wheaton Precious Metals, and of course their cash flow soaring, profits climbing because of this high gold price. How are you playing the gold market right now?
Well, I think the safer bet to be is in gold versus gold miners at this point. It's long in the tooth for gold and gold miners and the streamers as well. And we're seeing a consolidation phase with gold. A lot of investors are saying, well, why didn't gold go up when the war started? Gold's not trading that way. Once it gets into a consolidation phase, it trades off of other aspects like interest rates and U.S. dollar, et cetera. And we're in that phase right now. And the expectation was as well that the war wouldn't go on a long time. So we didn't see gold respond to going up on that. So I think gold is a safer play here versus the gold miners. If you had to choose between the gold miners and the streamers, I would actually be looking at the streamers at this point. Wheaton Precious Metals came out with excellent earnings, beat on the revenue, beat on the earnings. It's operationally is doing extremely well here. And what you find with the streamers such as Wheaton Precious Metals is when gold goes through a consolidation phase, which was what we've seen over the last couple decades, it rises and goes through the consolidation phase and then rises again. When in that consolidation phase, you find that the streamers actually do quite well. So as far as the ranking goes, I would say that gold is a better place to be than the streamers and then gold miners themselves.
So first the bullion itself, and then you'd go streamers and then the producers.
Yes, that's correct.
Yeah, I'm just looking here over the past year. Certainly, Wheaton has outperformed over the longer term versus the regular gold miners. Although it does look as though it's been lagging over the past year. But that I'm over 5 years it has been beating the gold miners for sure. Let me just look at how Wheaton has been doing versus the gold miners, and it has been lagging them a bit. I guess people see more leverage in the gold miners right now.
Right. Yeah. So if you take a look at, let's say an ETF like GDX for the miners, when gold was going up a lot, gold miners were outperforming, and you would expect them to beat the actual streamers. The streamers are a little bit more defensive than the miners themselves. And so when we saw that really strong run in 2025, you're going to see the streamers, such as Wheaton Precious Metals, lag the gold miners. But in this type of environment, the streamers, such as Wheaton Precious Metals, become more appealing.
You have a couple of ideas for us here. One of them is a Global X product, the Equal Weight Canadian Utilities ETF, UTIL. Tell us why investors should consider this one.
Yeah, for full disclosure, I work for Global X. But I think right now, if you take a look at what's happened in the markets, we've seen the shift from the growth of technology sectors into the cyclical sectors, such as industrials and materials. And then we start to see investors become more cautious and move into the defensive sectors recently. Investors aren't leaving the market, but they're moving into some of the defensive sectors. And I think in Canada, the utility sector is a good place to be. It's if we compare the utility sector versus the U.S. is much more attached to AI, so you can see a lot more beta with their utility sector versus ours. Ours tends to be more stable revenue and growth over time. Interest rates are fairly stable as well. So I think that the utility sector, which also does well seasonally here, particularly if the market struggles. I think the utility sector is a good place to hide right now in the markets, particularly in Canada.
Brooke, thank you very much indeed. Great hearing from you.
Thank you very much.
Brooke Thackeray, research analyst at Global X Investments. Just ahead, BYD, the global Chinese electric car maker, says it's considering building a manufacturing plant in Canada. We'll get more from our own Lindsay Biscaya after this. BYD, China's biggest car maker, says it's considering building a manufacturing plant in Canada. We're joined by our own Lindsay Biscaya. Lindsay.
This is interesting, Andy. I should say it's all at this point hints from the executive vice president of BYD, Stella Lee. In an interview with Bloomberg yesterday, she was dropping a couple of hints of what the company is considering, and that's what she was saying is that the company is considering or is studying the Canadian market for a potential manufacturing facility. And she said this in an interview. She said that they would want to actually own and operate this facility outright because obviously a lot of other companies, North American car manufacturing companies, do have partnerships with Chinese companies, right? But BYD has this kind of do-it-alone approach at the moment, and it sounds as though that would stand. So no decision has been made yet, but we do know that BYD has applied for a permit to actually export their vehicles into Canada. They did that last week, along with two other Chinese companies that are kind of preparing to enter the market ever since March 1st. Now, of course, we're in the month of March, and the Canadian government has that deal allowing 49,000 Chinese electric vehicles to be allowed into Canada. So this is all because of that. But it's going to be interesting to see how all of this plays out, because obviously, if you think about having a BYD plant that's owned and operated by a Chinese company here in Canada, we have a lot of different labor regulations. We have unions here when it comes to our auto industry that maybe isn't the same as what a Chinese company would have. So, speaking with analysts this morning, some people are a little skeptical as to whether this would actually ever happen, because there's a lot of kind of hoops that BYD would have to jump through to make this happen, and would have to change some of maybe their regulations and maybe their prices as well to accommodate.
So talk to us about prices, because in some cases, these Chinese cars, electric cars globally, are very cheap.
They are, yeah. And I think that's part of the reason some people are very excited about this new, the drop in tariffs that Canada has on Chinese electric vehicles. So when you're talking about BYD, there's one make called the BYD Seagull. It's talked about quite a lot because it is apparently, if it were to be launched in Canada, it will be the cheapest electric vehicle on the market. So it costs about $7,000 US. And so here in Canada, it would cost about $20,000 to $30,000 Canadian, which...
Why? That's because the way it is, I guess.
It has a range of 300 to 400 kilometers. So it's more of like a city vehicle, right? But it's quite a bit cheaper. There's the BYD Dolphin. The BYD Seal is more on the expensive range. But when you compare it with cars here, like a lot of North American cars, Chevrolet Bolt, Nissan Leaf, the Tesla, they range from like $40,000 to $60,000 Canadian. Why it's cheaper? There's a lot of different reasons, right? There's a labor gap is one of the main reasons, right? Like people who work in a manufacturing plant in China make about roughly $5 an hour. And you compare that to somewhere in Canada, people make about $30 to $45 an hour. That's one of the reasons. There's also, Canada or China has a lot of access to those critical minerals that are needed to produce the batteries, and then subsidized by the state as well. So there's a lot of reasons for the price difference, but it would be interesting to see whether it would actually work if they were manufactured here in Canada.
Lindsay, thanks very much indeed. Lindsay Biscaya. Right, it's been 1 year since U.S. President Donald Trump slapped punishing 25% tariffs on steel and aluminum. Now, that would later jump to 50%. At least one company has posted nearly $1 billion in losses. CTV's Annie Bergeron-Oliver looks at how the steel industry is doing 12 months on.
Ottawa's Ambico Limited sells 75% of its steel doors to the United States, a country that 1 year ago implemented heavy tariffs that reshaped North American trade.
We probably suffered in the vicinity of $500,000 of cash that we've had to pay unexpectedly. So that hurts.
Since the U.S. president initially slapped a 25% tariff on steel and aluminum products, costs have skyrocketed. Confidence from American customers has plummeted, and predictability, especially with CUSMA negotiations ongoing, has evaporated.
So we have a lot of variables that we build into our cost structure. Tariffs is a major concern if the CUSMA agreements fall by the wayside.
Ambico is lucky. Their manufactured products are CUSMA compliant and not subject to the Section 232 tariffs that are crushing primary steel producers like Ontario's Algoma Steel. Last quarter alone, Algoma Steel saw steel shipments drop 31% and reported a net loss of $364.7 million, driven largely by tariffs.
It's an illustrative example of the pain that the industry's been going through as we try to, unravel, if you will, 30 years of integration with the United States.
The industry is desperate for tariffs to be lifted and hopes ongoing CUSMA negotiations will do that. But today, the minister leading the review refused to take questions, and the industry minister offered no update.
What kind of update can you give us? When it comes to steel, our goal right now is to make sure that we help our steel workers. That's what we've been doing.
The association representing primary steel producers says it will take a long time to undo the damage caused by 1 year of steel tariffs. Annie Bergeron-Oliver, CTV News, Ottawa.
Up next, artificial intelligence is transforming the art of war. We'll take a look in today's Big Take. Stick with us. Artificial intelligence is rewriting planning for war and also blurring Silicon Valley's ethical lines. Bloomberg's Big Take takes a closer look at how AI is ushering in a new era of warfare and how it's currently playing out in Iran. Let's get more from Bloomberg's Joshua Brustein. Thank you very much indeed for joining us.
Thanks for having me.
Joshua, start off by telling us, if you would, what do we know about how AI is being used in the war against Iran?
So the main thing we know about how AI is being used in Iran right now is that the United States is using a system called Maven Smart System, which is built by the company Palantir, incorporates technology from various other companies, and is basically a way to quickly analyze information coming in about potential targeting strikes and go through the administrative process of executing those strikes. And the practical impact of that, the US government says, is that they are making these strikes much more rapidly than they have in past operations. There were 1,000 strikes in the first 24 hours of the war, which is far and away higher than, say, what happened in the 2003 war against Iraq.
Now, we've got Anthropic here in a face-off with the Pentagon. Anthropic has or did refuse to remove safety guardrails to stop its AI from being used for fully autonomous weapons or domestic surveillance. Just update us on that. Where has that dispute gone?
Yeah, it's interesting that this actually happened at the same moment as the beginning of the Iran war, because Anthropic's tech continues to be used as part of Maven Smart Systems. The fight between Anthropic and the Department of Defense is really about where this might be going. Anthropic says that its technology is not yet ready to be used to build fully autonomous weapons or be used in mass surveillance. That's been another point of conflict there. And the Defense Department said that this makes Anthropic a supply chain risk and says other military contractors cannot use its technology in situations where it's working with the Pentagon. Now, Anthropic said it's being targeted for political retaliation and has sued the government, and that lawsuit is just getting started now.
It is interesting, isn't it? Weapons that will be autonomous. Who do we blame if they kill people, kill civilians, for example?
Yeah, I mean, I think that that's a major question. If you have a system that chooses targets and strikes them completely on its own, and something goes wrong, where will the blame fall for that? Now, to be clear, that's not what's happening as far as we know in Iran now. It does seem like that's the way the technology is going. And that would mostly be on drones that would be operating outside of any radio contact and would, by necessity, be carrying out these sort of operations on their own. Technologically, that's where the Pentagon wants to end up. It's not clear where we are on that trajectory.
We're almost out of time, but of course the Iranians are no slouches at technology. I wonder, do they have their own AI tools in development anyway?
Yeah, I mean, I think one thing that the Iranians are known for being pretty good at is using low-cost drones in these sort of situations. We've also seen in the Ukraine war, and that has definitely been a factor so far in the fighting in Iran.
Yeah, those cheap drones up against multi-billion-dollar weapon systems. Yeah, thanks very much. It's a great story. That's Bloomberg's Joshua Brustein. Okay, yesterday on Market Call, joined by Stan Wong, and today on the show, and there's his top picks, Loblaw, Rio Tinto, and Vertiv Holdings. Today, it's Tony CRO of Caldwell Securities, and Tony will be taking your questions on Market Call on North American large caps. Just ahead, we'll have more on the impact of this Middle East fighting on markets. Stick with us. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. Canada's economy shed the most jobs last month in 4 years. Data from StatsCan indicates that the labour market lost 84,000 jobs in February. Economists had been expecting a gain of 10,000 positions. Jobs were mostly lost in the goods and services producing industries, with 18,000 jobs lost in wholesale and retail trade. Meanwhile, the unemployment rate edged higher to 6.7%. The report points to continued softness in the labour market. Shares in Enghouse Systems taking a hit, down 10%. The software company posted lower on profit in its latest quarter, with both missing estimates. Enghouse says it's dealing with ongoing economic shifts, changing predictions on AI, and an increasingly unpredictable global environment. However, the company is raising its dividend by 3%. Shares in Wheaton Precious Metals moving higher. The Vancouver-based streaming giant posted record 2025 revenue, up more than 80% year over year, and it also saw profits surge. The miner says earnings nearly tripled to just under $1.5 billion US, driven by higher gold and silver prices. It's also increasing the dividend. 18% is the increase. And there's a look at the TSX edging higher today. It has been a choppy week, though, for stocks. Let me just have a quick look at how the TSX has done this week. It has, of course, been helped by strong gas prices anyway. North American prices haven't done that much, but our market is down from last Friday's close of 34,339. As you can see, we're now below, we just at 33,000. And let's have a look at the US markets, see how they're faring. They are bouncing back a bit as the White House tries to ensure the world has a sustainable supply of oil. The S&P 500 now down about 2% this year. The Nasdaq down about 4%, and the Canadian benchmark exchange, the composite, is up 4%. Stock market slightly steadier today after 3 days of declines. Now, oil prices have eased off the highs that they hit after the US and Israel attacked Iran at the end of February. Let's get perspective from Colin Shizinski, Chief Market Strategist at SIA Wealth Management. Colin, thanks very much. What strikes you about the current turmoil in the markets? What's the most interesting thing for you?
For me, what we're seeing is that we've had this major shock. The markets didn't seem to be overly prepared that a war would start, particularly energy. Energy prices were well through February. We had the oil price settling down, was trading down in the mid-60s, and it had started to creep up a little bit. And then when with the war starting, we saw a dramatic ramp up very quickly in energy prices as the shock went through. And then we've seen this kind of, now we're starting to get a settling out, but a settling out in a much higher range. As I said, before the war, oil was trading in the mid-60s to mid-70s. Now it's kind of trading up into the low 90s. So that's a significant change in the markets. And I think we're still seeing the ramifications of that trying to work its way through.
Have you made any changes to your portfolios given the events of the past 2 weeks?
Absolutely. The relative strength analysis that we do had identified that there were a lot of flows in capitals ahead of the war. So some of the things that we had been doing through February, in fact, was actually increasing our exposure to energy, increasing our exposure to metals and mining, and increasing our exposure to the defense sector. Those were areas that had been and continue to show a very strong relative strength. Also in the BMO SIA North American Fund, we've rotated from the U.S. to Canada, and that's been quite a shift. And a lot of that is the focus on resources, but also on the currency that through all of this, the Canadian, the loonie has been outperforming relative to a lot of other currencies. Canadian equity is currently our highest ranked of the equity asset classes, and Canada's been a very strong area.
What about Wheaton Precious Metals? I keep forgetting to mention that we're going to be talking to Randy Smallwood of Wheaton later on the show. That's at about 10:30. Do the big gold streamers attract you right now, Colin?
Yes, and in fact, we hold the Wheaton in the BMO SIA Focused Canadian Fund, and it's a portfolio holding that we've been very happy with, and it's up today. And what's interesting, of course, is on this earnings and the dividend increase, which I think is really important as well. With the mining stocks, is that we had seen that a lot of them had very nice dividend yields. Then the prices all took off and the dividend yields went down. And now we're seeing the dividends start to catch up again because the companies only raise their dividends so often. The price can move much faster. So the increase in dividends is good. The trend has been fantastic in Wheaton. It's showing fantastic relative strength. And as I said, it's a holding that we're really happy with and very pleased with the earnings and dividend news that came out last night in the market, showing that too, with the stock up and silver down.
What about the copper miners? Are you interested in those right now, Colin? It's a two-way street, really. There may be difficulties producing copper if this drop-off in supplies from the Middle East continues. However, of course, this dispute, this war, is not good for global economic growth, potentially.
It's true. Copper has been a bit more of a mixed bag in terms of performance. But something we've seen over the last month, 2-3 months really, is we get periods where precious metals outperform base metals, and then we get periods where base metals outperform precious metals. But overall, what's important for us to remember is that copper is still trading at a very relatively high price, up near multi-decade highs, and so that remains a tailwind for producers through the daily ups and downs of the market and developments. And certainly, we are seeing a lot of volatility in the markets right now. But what we seem to have done is we basically have shifted from an upward trend to a sideways trend at the moment, we have good days in the markets. Like today, we've had a couple of great days in the market this week. We've had a couple of terrible days in the markets this week. But overall, where we're ending is that things are just kind of settling into a range.
Yeah, it's interesting, though, in the case of copper, the Gulf region is a huge producer of sulfur as a byproduct of oil and gas, and the copper industry needs that in vast quantities. So fertilizers, components of plastic, I think a lot of us, well, I am anyway, surprised to learn how many of these vital materials come from the Persian Gulf region.
It's quite amazing, and we are hearing about this now. It's something that the underlying materials are something that doesn't get talked about very much, and people don't really look at it. But yes, it's absolutely true, and we're starting to see that show up in other parts of the material sector. Is what is happening with these other ones that are getting caught up in this choke point that people didn't really think about until it actually happens. So there's a lot of realization and a lot of learning that has been going on in the markets, and in addition to, so that's why we're seeing a lot of reconsidering and repricing and capital flows, because as I said, there's a lot of things that people weren't really paying attention to that this war has forced everyone to start paying attention to.
And Colin, what are you tempted to increase your weighting in the good old Canadian banks? They have seen some selling this week. Maybe we could have a look at a one-year chart for the TSX Banks Index. Are you tempted in times of turmoil to load up on those stocks?
Yes, in fact, and actually over the last couple of months, something we actually have done is rotated out of our U.S. bank holdings and into our Canadian bank holdings. The Canadian banks, on a relative basis, have been much stronger than the U.S. banks over the last couple of months, in particular, and few weeks. And this is something that has accelerated. While the U.S. banks have weakened, the Canadian banks have held up really well, and particularly relative to the U.S. banks.
Yeah, I'm just looking here. They are up certainly this year, the bank stocks, as far as I can see. And yeah, oh, well, look at that though. Over the past 3 months, struggling. That's interesting. But of course, a lot of stocks have been under pressure. Thanks very much indeed, Colin. Really appreciate it.
Thank you. Have a great day.
Colin Trzynski, Chief Market Strategist at SIA Wealth Management. Coming up, should smaller retail investors be given access to private equity? There are concerns. That's next. Current focus for the Ontario Securities Commission is to open up private equity markets to smaller retail investors. The regulator argues that the move will benefit both retail investors and capital markets alike. Our guest has concerns. Let's hear more from Rachel Wasserman, founder of Wasserman Business Law and a fellow at Social Capital Partners and the Canadian Anti-Monopoly Project. Rachel, thank you very much for joining us.
Thanks for having me.
So there's a move afoot in the States along these lines, but can you tell us what Ontario is talking about, please?
So Ontario is looking at opening kind of like a mutual fund style product for private equity. And the concern has been that our public markets are declining, that we have fewer and fewer investment opportunities for retail investors. And the OSC thinks that it's a good opportunity to open the private markets to retail. While there are merits to the private market, I really don't think this is the best opportunity for retail investors. We have to look at, why now? Why is this happening? And in my opinion, the private markets are really overvalued. The private markets have served a purpose, and the retail investor requires more protection than accredited investors like pension plans. And so to equate the two is problematic.
It's interesting. There have been signs of a cooling affection among big, sophisticated investors, such as pension funds, for private equity.
Absolutely. Coincidentally, when my op-ed came out in the Globe and Mail, the Ontario Teachers Pension Plan took a loss on their private equity portfolio. I think it was a $10 billion write-down. Now, that's not to say that there's no merit in the private market, but we have to look at why this is happening now and what the trends in the future will be. We can't look at the past to be determinative of the future. And I worry that retail is being brought to the party at the wrong time.
Because behind closed doors is really a characteristic of private equity. It's not a transparent market. For one thing, you don't really know what your investments are worth from day to day. It depends on a valuation that is produced by some accounting firm.
Well, and that's exactly it. Mark to market versus mark to model are very different. And there's a lot of conflicts of interest in mark to model that are not in public disclosure. So there's, when we take an asset for sale, when on the public market you have the buy ask and all these people selling, and at the end of the day, you can sell. The question is just at what price. In the private market, liquidity is a far bigger issue. And the mark to model is based on the assumptions of the private equity fund manager and the valuator, who frankly has a bit of a conflict of interest. It's the same conflict of interest that underlined Enron, Sarbanes-Oxley, and the 2008 global financial crisis, which is the valuator wants to keep the valuated a happy repeat customer.
So just remind us, what kind of a vehicle is Ontario considering?
It's a mutual fund style product. I'm going to be honest, I'm not a perfect expert in the nuances of the actual product, but it is a mutual fund style product that would be led by a large private equity investor who could run the fund on behalf of retail and kind of take the lead, do the diligence. But even those types of investors have said, no, we don't want to do this. So it doesn't make sense to me as to why we're pushing this so hard.
And of course, the classic problem with private equity is the stuff is illiquid. You can't, it's holding stakes in companies. You can't just sell those overnight. And so if you get a run on the fund, they may have to suspend redemptions and people have their money locked up.
You got it. And look at it right now is happening. Over 40% of Canadian real estate funds are gated. I just don't understand how we can be having a conversation about opening this to retail at the same time as the smartest money in the world is scaling back. And if you understand the merits or how the private market works, you always need new money coming in. And that is traditionally relied on very sophisticated pension funds putting their money into these products, but they're scaling back. And this market needs new money always coming in. And it just seems a little too convenient that retail is now being tapped to come in.
Yeah, I mean, big players, Blackstone hit south of the border, hit by a surge in withdrawals from its flagship private credit fund. And we've seen funds here in Canada, at least one credit fund and real estate funds restricting redemptions. I mean, you do say that private equity has a role to play economically. Sometimes, of course, it buys a stake in a company and where management aren't delivering returns.
Absolutely. There is a role in private equity, and I think it's important that we don't demonize an entire industry. That being said, there's a lot of bad activity going on here. Part of my concern with private equity, which more aligns with the work that I do with the Canadian Anti-Monopoly Project and Social Capital Partners, is the extractive nature of it. Leveraged buyouts, subscription lines, they eat the cash flow of a business as opposed to relying on equity growth to deliver returns. And so, we look around at the economy and see what's going on. Our businesses aren't investing for growth. And so part of the reason why I started doing the work I'm doing now is I realized how unsustainable this model is. We can't just keep extracting. Eventually, we're going to run out of things to extract.
Thank you very much, Rachel. We'll have to jump. A fascinating topic, and people can read Rachel's op-ed, which she wrote with Ed Weitzer, the former boss of the OSC, and it appeared in the Globe and Mail. Thanks again, Rachel. Okay, coming up, fertilizer prices have jumped because of the closing of the Strait of Hormuz, and farmers are worried. About a third of global seaborne fertilizer shipments have been stuck at the Strait of Hormuz. And farmers face a decision. Should they buy more at these higher prices? Meanwhile, shares in fertilizer companies have been jumping. Let's get more from Sal Gilberti, CEO of Teucrium, which offers ETFs that track agricultural commodities. Sal, update us on the latest situation in the fertilizer industry, please.
Sure. Most of well, not most, but a good deal, as you've stated, of the global fertilizer comes through the Persian Gulf. So the Straits of Hormuz being closed is hitting fertilizer markets very hard in terms of supply. And this is probably the worst time it could happen, because about half of the nitrogen needs of corn need to be put on at planting time in the spring. And we are just now, we're starting to plant in the south, and we're going to move up towards you there. And so right now is the time that farmers need nitrogen. If they didn't pre-buy it, that's going to be a much higher cost factor in their planting decisions. And those that can, and it's a small margin of people who can, but it adds up to quite a number of acres, they're going to switch away from corn and to soybeans, because corn takes nitrogen. So you need to apply nitrogen to the soil when you plant your corn to have a good crop. And soybeans basically fix nitrogen. They put nitrogen back into the ground or allow it to stay. And so any farmer that is able, who's going to face higher fertilizer costs, which they most certainly will because of this logjam in the Straits of Hormuz, they're going to switch from corn to soybeans, and that may have a pretty significant effect on prices moving forward.
I'm looking at the Teucrium corn ETF, and it is down over the past year, but it has bounced certainly over the past few weeks.
It has, and that's in direct response to, when energy prices go up, they do two things for corn in particular. One, they raise the input costs, so they raise the cost of production. And two, they raise the cost of fuel. And of course, a big component of fuel around the world, especially in America and Brazil, is ethanol, and ethanol comes from corn. So corn is impacted very directly by higher energy prices.
Have you been seeing big inflows into the fund?
We have. There have been enormous inflows into all the grains because they're a portfolio diversifier and stabilizer, I think, as you and I have talked about in the past. Corn in particular has some very cyclical natures, where when you're down near that $4 a bushel, and we're about 50 cents off of that right now, higher, it trades sideways. And then if there's a drought or something, it can go substantially higher, and has done so 3 times in the past 17 years. So grains as a whole tend to either be stable or vastly outperform the S&P 500 during drawdowns of 10% or more. So you've seen a flight to safety, which grains are in that for advisors who know and investors who know. And you've also seen this opportunistic investment in corn and wheat in particular, those two, because they require fertilizer. And right now your fertilizer is stranded. There's going to be a bottleneck. And until the Straits of Hormuz open, you're going to have farmers who are facing planting decisions in the next basically 8 to 12 weeks, making the hard decisions of whether or not to plant corn and buy their fertilizer at a higher price, or to forego planting corn and plant soybeans instead. So that's why corn's seeing inflows and a lot of attention right now.
I think we can show a chart for WEAT, which is your wheat ETF. And that one is down over the past year, but it too has had a pretty sharp rally lately.
Again, geopolitics. Wheat is. Some people say wheat is a more political commodity than oil. It's referenced, 73 times or something in the Bible. Wheat is intertwined with human history more than oil for a much longer period of time. And so wheat's a very political commodity. Again, flight to safety into these grains, and when energy goes up, it does affect all the grains, corn in particular, and wheat does feel it, especially when there's a fertilizer problem like we have today.
As you know, barley is a very ancient crop, might have been the first crop grown on a large scale in Iraq, what's today Iraq. Have you ever considered a barley ETF? I guess it's a smaller market.
That's one we've not. People have asked us about oats. They ask us about coffee and other commodities. But right now we stick with the giant commodities, the ones that people have interest in. They're highly liquid, so you can move as much money in and out of these things as you like without any issues. So we've just stuck with corn, soybeans, wheat, and sugar.
I think we don't have your soybean ETF right now, but we can maybe show a one-year chart for soybeans themselves. And your soybean ETF it's rallied lately, but it's up about 16% in the past year, the ETF.
Yeah. Yes, it is. That ticker is SOYB. We have pretty easy tickers. And it's again, these things follow the price of the underlying. They hold the futures of the underlying, and they follow those prices. If the futures move up, the funds tend to move up. If the futures move down, the funds move down, and those returns are corresponding, less, of course, the fees and expenses.
Do you find that farmers tell you they're buying the ETF? Because many of them are very sophisticated players in futures.
Sure, some do. Futures are a tool because you can make or take delivery, so you can turn them into the physical commodity, whereas the ETF just gives you price exposure, and you can only leverage the ETF 50%. You can leverage futures if you're a farmer by 10% or even less than that. And so a better use of a farmer's money for hedging is definitely directly in futures. But a lot of farmers call us and say, hey, I see that the crops are bad. I'm actually going to invest in your funds in my IRA for a while. So we do get those calls, which is interesting and nice to hear that people are using our funds when they find it appropriate.
So you've got soybeans, wheat, and corn. What other farm or food ETFs do you have, Sal? Can you remind us?
Sure. We have cane, which is our sugar ETF, and then we have two funds that trade all four together, equally weighted 25%. One is called TAGS. It's the Tucrium Ags. And that index is particularly important because that index, if you go back the last 7 times the S&P 500 has fallen 10% or more, the TAGS index has outperformed it. In fact, the average drawdown amongst those 7 times of TAGS was less than 1%, and the average drawdown of the S&P 500 was 17%. So when people see that, they do move into these funds kind of as a defensive play or a very effective, as shown historically, effective diversifier to a portfolio. So there are a lot of people who want a commodities exposure. When they buy a commodities index, it tends to be overweighted to energy, and they want to boost up that agricultural exposure. So they use our ETFs. That's very important. And then we have another one called TIL, like tilling the field. And that's just a different tax form. So a TAGS sends you a K1. If you don't want that, you trade TIL. They're in essence, they have the same exposure, 25% to each of the big 4: corn, soybeans, wheat, and sugar.
Sal, thank you very much indeed. That
Pleasure.
is Sal Gilberti, CEO of Tucrium. Coming up, we're going to talk to Randy Smallwood, outgoing CEO of Wheaton Precious Metals. The company posting record revenue in 2025 as gold prices soared. The Canadian job market struggled in February. It lost the most jobs in more than 4 years, and that helped drive the unemployment rate up to 6.7%. As StatsCan said, employment fell by about 84,000 jobs. The losses concentrated in full-time work and the private sector. The job losses suggest the labor market remains soft as the economy bears the weight of U.S. tariffs and the upcoming review of the CUSMA trade agreement. The Trump administration has begun a second trade probe in a bid to replace the emergency powers tariffs that were rejected by the Supreme Court. The U.S. Trade Rep, Jameson Greer, says the targets of this investigation include Canada, Mexico, the European Union, China, and Britain, among others. The investigations will determine, the White House says, whether acts and policies of each country related to the import of goods are discriminatory and burden or restrict U.S. commerce. China says it will impose anti-dumping tariffs on certain rubber products from Canada and Japan, with the new levies taking effect tomorrow and remaining in place for 5 years. That's according to China's Ministry of Commerce. Tariff rates will be just over 30% for most Japanese companies and about 14% for Canadian producers. North American markets holding in, but it's been a choppy week for them. You can see the TSX edging up about 1/3 of 1%. It has been frustrating, though, amid this uncertainty over the impact of higher energy prices. Investors have been betting on economic weakness. Now, over the past 7 days, the past week, the S&P 500 could be worse. It's down something like 1%. The TSX down about 0.5%. Vancouver-based Wheaton Precious Metals posted a record $2.3 billion in 2025 fourth quarter revenue as gold and silver prices surged. Let's get more on those results. We're joined by Randy Smallwood, CEO of Wheaton Precious Metals. Randy, great to see you. Talk about the year, if you would. It was a bumper period for anybody involved in gold and silver.
Well, I can't imagine a more perfect setting for us to have such a strong growth profile in sort of timed with such a strong increase in commodity prices. Both gold and silver, of course, climbed to record highs through the year, and our production is continuing to grow. We've got a lot of new projects coming on stream. And I think these higher prices have actually driven a lot of growth at our partners' operations. And so really excited about where we are.
What is you're producing the equivalent of what in gold right now? Or what did you last year anyway?
Well, last year's overall production was just over 690,000 gold equivalent ounces, which beat guidance. I think our guidance was down around 640. And so beat our guidance healthily, a healthy bump on that. Mainly outperformance from Salobo, which is our flagship asset, but also from Peñasquito and even Constancia down in Peru. And so good, strong guidance. Of course, converted into the new GEOs, that was just over 800,000 ounces just because of the silver gold ratio changing.
Yeah.
This year we're expecting to be somewhere around 900,000 ounces of production. So good, strong growth even this year. And as I said, climbing to 1.2 million gold equivalent ounces by 2030.
Well, you and I talked about this a little while ago. Can you give us a ballpark estimate? How much of your cash flow is coming from silver now? Can you give us even a rough estimate?
Well, I mean, we were just under 40% silver and close to 60% gold in in 2025. Now, of course, we just did a slightly large acquisition with BHP in terms of a new silver stream down at Antamina. That'll kick us up. We're about even right now, but we've got a lot more growth on the gold side. There's the gold market is just substantially larger, and so we see a lot more opportunities in that space. So, I would predict sort of long term we'll always, by 2030, we'll probably be up around 70% gold, 30% silver. Some of that does, of course, have to do with how each metal performs. I am a bit more bullish on silver just because it's got better fundamentals behind it. But the size and the focus of gold is something to be respected in terms of how big that market is and where the demand is coming from. But I would sort of guide towards long term. We're going to be in the 70% gold, 30% silver range.
Do you get, when you sell your gold and silver, obviously your business model is buying it at a discount or obtaining it at a discount from your partners. Do you get pretty close to the actual spot price, or how does that work?
Well, actually, we've got a team that that trades opportunistically metal sales team, and we traditionally beat the average spot price. I know we did really well in the fourth quarter just by holding on to some metal as we had that strong run and then pushing it out towards the end of the quarter. So it's one of the reasons that helped us do that. We've got a metals team, metals trading team that has definitely earned their salaries. They do a good job.
Do you ever stockpile gold thinking, it's going to go up a bit further?
I've been a long believer in the KISS principle. Keep it simple. We provide access to profitable precious metals production. We never carry a balance over a quarter. Every one of our shareholders has the opportunity to go out and buy physical gold and silver if they want to. As soon as I do it, I'm forcing them all to do that. I would much rather just keep our business model simple, focused purely on precious metals, focused on growth, top quality assets, profitable production at high margins, low risk.
And your yield now, I'm not sure. So you just announced a dividend increase, did you? My Bloomberg.
Yeah, that's right. Bumped up by 18%. We're now 19.5 cents per share per quarter, and we intend to stay. I mean, we've committed to a progressive dividend, and we intend to stay near the top. I'm always proud of what percentage of cash that we actually do return to shareholders through that dividend, and so we intend to stay near the top of that in the entire precious metal space. Our shares have actually performed quite well, so the overall yield isn't super attractive. We're not getting sort of yield investors, but that isn't really our focus. Our focus is to be that foundation stock for everyone in the precious metal space. Everyone needs a little bit of gold in their portfolio. We should be that foundation stock.
So we just showed a one-year chart of you versus the TSX Global Gold Index, and you have been lagging, although you've caught up a bit lately. I think it looks as though investors were seeking more leverage over the past while, but certainly you have beaten the Global Gold Index, the stock index, over 5 years.
Yeah, I mean, there was a bit of a swing towards leverage last year as we saw a dramatic uptick in gold price and silver prices. But one of the concerns that I would say, and I think what we're seeing is a little bit of a shift back towards the streaming companies is costs have to chase that commodity price. It's just unnatural to have such a high margin between the gold cost curve around the world and the actual spot price itself. And so that lower grade material is going to work its way into the mills. We're going to see inflationary pressures. All the oil issues that we're having, an increase in oil costs, diesel costs, going to have an impact. And so I think what we're going to see is probably, I think this year we're going to start to see a shift back, because I really do think that costs are going to be ever increasing challenge for the actual mine producers themselves, the mining companies themselves. Of course, the strong beauty of the streaming model is there is no cost risk exposure. You don't get the inflationary pressure that the mining companies will suffer from.
And I know governments can read the papers. They can see the way the gold price has gone, and they are tending to seek a bigger take. I know Ghana, a major producer in West Africa, is now talking about revising royalties.
Yeah, it's one of the reasons why we really put a lot of focus on staying in the first and second quartile. 83% of our production, actually, I think it's 85% now, of our production now comes from first and second quartile assets. These are assets that are profitable enough that every stakeholder will get a good share out of it. Everyone's happy, and so it's such an important aspect of making sure that we invest wisely. It's really the first question we ask whenever we're looking at opportunities is which quartile does this asset fall into? Because we want to have healthy margins all the way around the table.
Thank you very much indeed. Really appreciate it. Randy Smallwood of Wheaton Precious Metals. Okay, ahead we got hot picks and we got ideas among the internet giants. We'll be right back. Hot picks today, we are zeroing in on internet stocks. Our guest has Amazon as his top selection, and he points to a multi-year partnership with OpenAI. He thinks it will enhance the already awesome computing power of the company's cloud business and also bolster its consumer franchise. Let's get more from Ron Josie, senior internet analyst at Citi. Ron, great to see you. Thank you very much indeed for joining us. Just remind us, what is Amazon doing with OpenAI?
So thanks for having me, Andrew. Look, Amazon is doing a lot of things with a lot of different companies. On OpenAI specifically, more recently, they announced an investment directly in OpenAI. So when OpenAI was raising funds, Amazon is now a pretty large shareholder, I think upwards of $50 billion over time, with $15 billion committed. But then also included in that deal was I believe, $100 billion, call it compute, 7 or 8 year deal, which is more around the AWS side, where OpenAI would rely on AWS's compute capacity for all of its services and everything that they're doing. And so OpenAI requires a lot of compute. I think we can all agree with that. AWS and Amazon is now one of their main partners, in addition to their partnerships with Google Cloud and Azure. But the big news is that Amazon is now part of the mix here as well.
And is AWS, the cloud business, is that the real driver for Amazon in investors' minds right now?
In the short term, yes. You use the term right now. I think that is the biggest debate. And when you think about Amazon, you think about the CapEx that the company is spending, and I think they've set upwards of $200 billion this year. We think of that around 150 or so billion will be related to AWS. The big debates that I hear and are having with my clients is all around what's the return on investment. When can we start to see AWS revenue growth? Specifically, when can we start seeing AWS AI demand start ramping? And so we're starting to see revenue growth reaccelerate. We saw that in 2Q and 3Q, again in 4Q. The question is a mid-20 growth rate enough to support $150+ billion in CapEx? And that's the big question in the debate that we're having. We actually think that there's probably more upside to the growth rate than what many probably expect.
So Amazon stock down about 8% this year, in line with a decline in the Mag 7. Alphabet's been a relative star, Alphabet/Google. It's down only about 2%. And that's your next idea.
Yeah, I mean, the thing with Alphabet is they are so well vertically designed and in place, actually, from a strategy perspective. If we just take AI as a point of view here, when you think about AI, of course, you think about a lot of different things. One of them increasingly is Gemini. And so Google's Gemini LLM and model is amongst the best, if not the best. And with that, they're building out the Google Cloud platform. With that, they're building up their Google search business. And so when we think about AI as a percentage of total revenue, we just see that continue to grow, and we're going to find that appear and manifest itself in increasing, or call it accelerating, Google search results in terms of revenue, and certainly accelerating Google Cloud. So wrapping up Google really quickly, they have the model. They've got their silicon with their TPUs. They have the platform, and they increasingly have the scale. When you put that together, Google is incredibly well positioned, and that's why I believe the stock is acting a little bit better. They're still down post earnings, as there's some debate on pricing and on, call it, how expensive the stock is from a multiple perspective. But we're willing to look beyond that, because we actually think that numbers are likely to go higher, particularly on the profitability side.
And then finally, Meta. Meta is down about 4% this year. So relatively, it's done all right. Where's the big upside in Meta, do you think?
Look, the big debate on Meta is they too are spending a good amount. Unlike Google and Amazon, where they have a hyperscaler business where they're working with thousands, if not hundreds of thousands of organizations to outsource compute, Meta isn't. Yet we're spending, call it $125 billion on our numbers of CapEx for this year. And so we are waiting for when can we sort of calculate the ROI? We are waiting for this new product super cycle that will be based on Meta's investments over the past year or so around AI. The good news on Meta, in our view, is even though some of their newer models might be delayed or are not yet ready for prime time, their core business is doing incredibly well. And so when we think about their core advertising business and overall revenue growth accelerating to 33%, call it in 1Q, we actually think that that's a great indication that once their LLMs and their models are fully implemented, we actually think you can see sustained revenue growth rates higher than probably where consensus is right now. And so, but until we get there, that's the debate on Meta, and maybe that's why it hasn't participated as well in whatever AI rally over the past couple months.
Again, Meta, massive spending on AI, and you generally feel that's going to pay off.
You know, we're seeing some incredible results from Meta without their LLM investments driving that. In other words, their ranking and recommendation models are improving most every single day. And as they improve, what does that mean? You and I and most people spend more time because the content is better. And as we spend more time, Meta has more signals about us that they can better target from an advertising perspective. And so they've been able to accomplish this without really having the best models driving these ranking recommendation changes. Once we actually get these models live, which might be the next couple of months or so, I think you will see continued ranking recommendation changes, perhaps even an acceleration there. So the core business is operating really well. The next phase of the business is when these LLMs launch, and we actually think that's going to happen in the next couple of months. When it does launch, then we should start seeing even better results from Meta's perspective.
Thank you very much. I really appreciate it. Ron Josie.
Andrew, thanks for the time.
Ron Josie is Internet Senior Analyst at Citi. Canadians, of course, heading out for March break. What about their travel plans for the year as a whole? Something like 4 in 10 of us are less likely to travel to the United States. We'll have more after this. A new poll conducted by Nanos for CTV News indicates that about 40% of Canadians are likely to travel less to the US this year. And another 40% or so don't vacation there at all. CTV's Rachel Aiello joins us now with more. Rachel, tell us about the main findings, please, in this poll.
Yeah, good morning. So what Nanos research has found is that 43% of Canadians are less likely to travel to the United States compared to last year. Around 38% said that they don't vacation in the U.S. at all. And just 4% said that they are likely to spend more leisure time south of the border this year. So clearly this is an indication, Andrew, that this is an ongoing extension of Canada's, domestic push to buy Canadians, spend time, spend money in Canada, sending a signal to the United States that they are displeased with the state of Canada-U.S. relations, specifically around the trade war and the tariffs. But, as I was thinking about this morning, there may also be some other factors at play here. I'm thinking specifically of the value of the Canadian dollar compared to the United States and how much more expensive it would be to plan a vacation south of the border in the U.S. than it would be to do something in Canada. And then, of course, some of the uncertainty around the domestic situation in the U.S. I'm thinking about Canadians crossing the border, or stories we've seen about interactions with border agents, or overall the hesitancy around their immigration push. So those could be smaller level factors, but clearly what Nanos numbers are showing here is that Canadians are opting not, more than in recent times, to travel to the U.S.
And then last year we had this Canada Strong Pass encouraging Canadians to holiday at home, and you got free admission or discounts at Parks Canada parks or museums that took part. Via Rail offered discounts. Did that do much for vacations in Canada?
Yeah, according to these numbers, it absolutely did. 49% of Canadians who were surveyed said that the Canada Strong Pass had a positive impact on their travel plans and making decisions about where they were going to spend their vacation time. So clearly that was a move that was supported by Canadians. We saw that, of course, introduced first after the last election, and then this fall, the Prime Minister announced it was coming back. So we saw the Canada Strong Pass available over the winter holidays between December and January, and it will be coming back again, Andrew, as of June, so that opportunity will be there again.
Rachel, a while ago I was at the famous Prado Museum in Madrid, and I was surprised to find out that journalists get in free. I've never seen that anywhere.
Good to know.
Yeah, so I will add
that to my list.
I showed my CTV identity, and journos get in free. I felt like crying a bit because we journalists, we get no respect. Anyway, thank you very much. But that's a tip, and it's
no problem.
And it's an incredible museum. Thank you very much, Rachel Aiello, our colleague at CTV News. That wraps up this edition of the Open. Morning Markets is up next. I wish that idea would spread. Journalists get things free. Anyway, thanks for watching. Have a great weekend.